Hi, I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network. Today on the Econ Show, we had a lot of data dumps from around the world, so we're going to try to piece it apart and move through things quickly. So in this segment, in segment one, we're going to go through global growth. We're going to look at PMIs, what is happening with global growth, is it starting to slow, where do we see some of these supply chain issues. Then we're also going to touch on and provide some of that backdrop on food, and then provide an update on what is happening in Iran, what is happening with some of the different fighting that we've seen in ships, because there's a lot of misnomers moving around. So then after that, we're going to go into more depth on the Q2 GDP, break it down, but then also look at what comes next, because Q2 already happened, where we just finished July. What is going to come next, and what are some of the leading indicators telling us? Where did we close out July, and what does that mean for August? Then we're going to look at U.S. consumption and really what is happening with some of these leading indicators that are starting to soften up a bit, and what does that mean for growth as we go through the end of the year. So then when we look at Europe in segment 4, we're going to look at European growth, which is still growing, but it's missing estimates. And that's something that I think we continue to try to talk about, of where are we in relation to what the market expects. And we continue to see us coming in well below what the expectations are, and seeing some of this disappointment. And that's something that we see happening again with Asian slowdown continuing to accelerate and within that region, but also it's being led by China. China continues to see things moderate. Japan has gotten a bit stronger, but again, we're going to go through some of those different pieces, especially in Asia, because it has a big backdrop for trade and other. But then the other key piece that we're going to talk about in segment 1 is also going to be a bit on the tech side, but that bleeds into PMI and some of that growth. So now to kick off in terms of where we are, this I thought was a really good chart, just looking at emerging market food vulnerability. And we keep talking about food and the issues that we continue to see. And this gives you an idea of just how bad it is in some key areas. And we're going to touch on India for a second as well, just because we continue to see some of those pressure points. So when we look at another 291 million people won't have enough to eat this year, that will drive up world hunger numbers by a third. Most of the increase is expected to come in Asia and Africa, which again is what we've been talking about since last year. But even before that, when you look at food insecurity, how that's continued to grow. So over 1.2 billion people in 76 countries covered in the USDA report, representing 31% of their population, will be food insecure this year. Prior to the pandemic, it was estimated that it was 761 million people, or less than 20% of the populace. So you get an idea of just how extreme not only COVID is, but also the issues that we continue to see on yield, on growth, on droughts, floods, things that are just taking supply out of the market, driving up price and increasing some of this constraint. So then when we look at most of the additional people the USDA expects to fall into food insecurity this year are in Asia, which accounts for 72% of the increase. Bangladesh, India, Pakistan, and Indonesia will see particularly large jumps in the number of people without enough food, according I just lost my place. I apologize. According to the most recent report, Sub-Saharan Africa accounts for 21% of the global increase of undernourished people. So you can look at just this brown area right here in terms of just how much that is going to impact across Southeast Asia, across the just India in particular, and the surrounding regions, just at how detrimental it's going to be over time. And unfortunately, because this is now going to be the second year without a really good bumper crop, and what's projected going forward, how things continue to shift on the weather side, droughts, floods, we're seeing that continue to become a pretty common stay. All the while, all of the stimulus continues to pump through. And I just thought it was funny because the Bloomberg Barclays Global Aggregate Negative Yielding Debt Market Value is now at 16.67 trillion. And we are continuing to move up. And remember, we did reach a high at the end of last year at 17.76. So we are making another run for it. But now back to something a bit more, not to say that negative yielding debt isn't serious, but this just gives you an idea of some of the pressure points. And this looks at one specific area within India that just shows what happened pre-flood and then post-flood. So you can see it just how expansive and how detrimental a lot of this flooding is. And it's taken out, large parts of surrounding farmland in terms of some of the areas that have been inundated with this water. And it's happening everywhere. And you either have pockets of extreme drought or pockets of extreme flooding, and a lot of those floods are essentially just crushing or saturating this farmland and just destroying yield or destroying the crop altogether, or they're just having droughts which are being met with an increase in irrigation, but is impacting in total yield. So again, these are things that are becoming a much bigger issue. Now back to some of the things that have been happening within the Gulf of Oman, the Strait of Hormuz. So the IRGC boarded the Asphalt Princess in order to capture it and take it to the Iranian coast. And what did the crew do? But they disabled it. So they disabled the engine, so it was just drifting. It sent out an alert, and they... what happened, but when you look at what is present, well, the Ronald Reagan, the USS Ronald Reagan and the Iwo Jima are fast attack assets, and a U.S. carrier fleet were in the region. So we responded very quickly. There were several countries that also responded very quickly, and the individuals escaped from the ship onto a waiting naval vessel or IRGC fast boat to escape before we could get there. But again, this just shows that they're trying to create more strife, more issues in the region, driving up pricing for insurance, increasing a certain amount of the uncertainty, which is why it's so important to have counterterrorism, anti-piracy assets in the region. We have fast-acting components, but it was good to see that nobody was harmed and the response was quick. So this gives you an idea of just kind of where these different groups are, because we always have different groups around the world. This is as of July 29th. The previous one was as of August 3rd. So you can see just where we have some of these assets this week when you look at the Amphibious Ready Group, the Marine Expeditionary Group. So you can see the USS Iwo Jima was underway in the Persian Gulf. Again, easily capable of handling the situation. But then when you look at the Carrier Strike Group, which are some bad boys that can do a lot of damage to a lot of different things, was also in the region and was also in the Arabian Sea. So when you look at things that had the ability to respond quickly, we also have assets within specific regions of the Middle East that could also respond in a moment's notice. So that was a positive. Now, this follows quickly off of what happened with, as we said last week, the Mercer Street, which was, Israel had claimed ownership of doing it. Now they're starting to back up and say that they didn't do it, but it was a one-way drone. It was able to cause damage. It killed a Romanian and UK citizen on the 600-foot vessel. Now it is owned by a Japanese entity, but is operated by an Israeli businessman and an Israeli company. So again, you're just starting to see this conflict, and the Israeli owned the Al-Oman Iranian state-run News Corp said that this was carried out as retaliation for last week's attack in the Syria's military airport. So again, you're still seeing this ratchet up, but the response was swift, and I think you're going to continue to see some of these battles back and forth, because remember, Iran has to project strength. What do we continue to see is there's water shortages, protests, a lot of strife internally as a new regime is coming to power. You just had essentially the affirmation based on the supreme leader of Iran saying that I agree with what was who was voted for. They can come to power, and then we'll have this swearing in ceremony very soon. So you're starting to see some of these shifts, which is why you're starting to see some of these actions that are swiftly moving out. But again, these are things that we're going to have to continue to look at and see if there's any other flashpoints. Now, one of the funny things, because it's the Fed and the ECB. Now, I've joked about this on Twitter. I've joked about this in previous times, but the The Fed and ECB continue the transitory narrative. So you can see the Z-score telling the 1 year average ratio of transitory to high frequency language and central bank speeches. So the ECB and the Fed are at the high level for transitory. So you can see at this point, if you say it enough, I guess it'll be true. And throughout the next few segments, we're going to talk about how this is less than transitory, how there's continuing to be price increases in general. But I think that this is a fairly funny chart looking at just how they are trying to wish it to be true. So when we look at globalization, I think this is an important thing to look at, the globalization plateauing more than a decade ago. And when you look at the movement of products, and this is looking at world trade volume, we've really seen that flat line. And as we've been talking over the last 10 years, we've been exporting inflation. We've been exporting the supply chain. We've been trying to essentially get this into a asset light at time deliveries. So there was always a movement of trying to maximize efficiency and inventory levels and trying to get to this point. But we've reached a point of saturation, and that's why when you look at the disruptions that have happened, when you look at how some supply chains are shifting out of China into other areas of Southeast Asia, it's going to become more expensive. It may adjust some of the supply chain in general, but again, this is just highlighting that we're reaching a peak we're past peak efficiency. Like because everyone, some keep saying that, technology is going to take us lower. It's going to bring costs down again. There's a point of terminal velocity where it just doesn't get much less. And I think this is something that I think drives this home on just a volume level particularly, but we'll talk about tech in a minute. But before we do that, we want to look at the global composite output index. So the global composite PMI fell again to 55.7 in July, 56.6 in June, to give a further hint that the global economic recovery peaked in May. The US and Eurozone remained bright spots, whereas growth was subdued in Asia. So this is just showing again that we had that peak in May. June was a little bit less. July was again moving out of Q2 earnings, moving out of Q2 GDP numbers. You're starting to see that you're getting this hindrance moving further down, which again I think speaks to some of the pressures that we're going to talk about that are not unique just to the U.S., but are also a problem when you go abroad. And again, 55.7 is still growth. You're still expanding at 55.7. This is not me sitting here saying that we're going to contract, we're in a recession. It's just estimates and expectations have to moderate when you look at what some of the views are within the market. And this is just putting it all together. So when you look at the composite, manufacturing and services, you're seeing that moderation. So JP Morgan Global July Service PMI, 56.3 versus 57.5 in June. Employment falls versus the prior month, lowest reading since March 2021. Composite falls to 55.7 from 56, and then lowest reading since March 2021 as well. Employment falls versus prior month, lowest as well versus 2021. So you're seeing employment slow a bit. You're seeing some of these overhangs in June, and unfortunately, they don't get much better in July. And we'll go through some of those different pieces where so far in July, we've actually been missing estimates, which again just points to an additional move further towards 50, and just some of this moderating growth that continues to strike some of these different areas. Now, when we shift a bit to one of the big issues when we look at pricing and some of the drivers of inflation and just some of the normalcy, here's where you look at Korea semiconductor exports, which continue to push higher. We bottomed, and I think this is important to highlight because you have to look at 2019, because remember 2019, we were fairly bearish. We thought that there was going to be some concern about global growth. Things were adjusting a bit, and that's where you saw this flat line. Now you saw this big increase in semiconductor exports, but also look at price. Like look at where prices have been in throughout historics and where they've gone. Now, we continue, we bring on new capacity, we bring prices down. But now we're starting to see those prices go back up. Now, I'm not saying that they're not going to moderate, because they will. It's just, what is the new normal? And when you look at the backlog and demand, we're over 20 weeks now for delivery. We have, I don't know if, even though some car prices have moderated, we still have a lot of shortfalls when you look at supply chains, when you look at the backdrop of tech and chip demand, which again is going to keep some of this DRAM spot price elevated in relation to where it should be on a normalcy level. Because when you look at 2020, if you say that is a comfortable level, again, this is where, does it normalize in 2021? No. The question is going to be, where does it shake up in 2022? And that's where I think that people are going to be surprised at not only the prices that remain, but the shortfalls that are going to persist in the world. Looking at just when we consider global semiconductor sales continue to go higher as semiconductor manufacturing sales move up. But the issue is delivery time, because if you see the panic and it's going to take you 20, 21 weeks to get it, you're going to try to put in orders ahead of time, trying to make sure that you have some of that backdrop and some of that, not only to just replace inventory, but also to have some of this parts capacity to provide some of that needed support. So when you look at semiconductor manufacturing incentives by country, this is one of the big issues that I think needs to be addressed, and we're trying to find ways to do it. But when you look at grants and subsidies and other types of support, we really haven't had any, and that's where you've seen this shift, if you will, in terms of where the creation is. Then you look at China, 50 billion, Korea, 7 to 10 billion. So it's not surprising to see a lot of these individuals see the growth and being advantageous to build capacity in some of these Asian nations. And the U.S. is trying to account for that and adjust for it by teaming up with companies out of Taiwan Semiconductor, to bring some of that. And it's going to be a matter of what are some of the tax incentives. There's already been discussions on not just because this doesn't really counter, because this is looking at federal, but there have been state tax benefits. So this is a little skewed in terms of what the benefits are, but there's ways to marry state and federal to try to provide, and again, bring on and onshore again some of what we've offshored for the last 40 years, and try to bring back to provide some capacity and some recourse for supply chain disruptions as we've seen. But it's capital intensive. And as we've been saying, and I think it's very important to understand, when you look at the amount, 20 billion to build a 5 nanometer capacity, when you look at the foundry and logic, and just where a lot of that is expected to be built, with 83% in Asia, with China taking the lion's share. And that's something that we're looking to address, because it comes down to national security, means of protection, which is why the U.S. is aggressively trying to find ways to become more than just that 9.8% and shift maybe some of that from Taiwan and South Korea into the U.S., or just increase it in general. But again, it comes down to money, margins, because $20 billion, because think about what logic is needed, what kind of capacity. Everything is getting smarter, faster, and the idea is not so much cheaper anymore, but smarter and faster. So the demand for the smaller chip and the wafer is getting much more aggressive, and that's why some of that cost is going up as well. The U.S. does build a lot of the equipment needed to assemble it, so there's a certain amount of cost savings there, but these are going to be things that they're going to try to drive home to increase the capacity within the U.S. And then the share of economies exceeding pre-recession peak in GDP per capita within 2 years. You're getting an idea of kind of what some of that slowdown, where the advanced economies, most of them will see that, but emerging and developed economies are going to struggle. And this comes back to inflation, as we talked about, food, and more importantly, the inability to stimulate the same way, as a lot of them, as we said last week, are already in a rate rising cycle, which is, again, kind of capping some of that capacity, which is why when we look at some of the longer term impacts, it's going to remain at the emerging market and developed economy side. But then when we look at the OECD GDP and housing prices, you can see just where those home prices continue to surge higher. It's coming back on a percentage level when you look at OECD, coming back into what it was in the 80s and, even above the '06 peaks, even as GDP kind of, is still recovering from these lows. The inflation or the stimulus, is I think this is a very good way of seeing, what that has done to asset prices and how that's created a different problem away from the one that we already can see, touch, and feel. So then when we look at home prices around the world, this gives you an idea of just what that increase in pricing looks like when you look at it from the percent change from the end of 19 to the end of 2020. And you can see just where we sit, where on average, a lot of these countries are anywhere from 5 to 7%, all the way up to about 15 to 20%. And that is, again, going to be difficult because that translates to rent. And we still haven't seen a lot of that transition to, which is, again, that next wave of CPI. We still have gasoline prices at $3.15. You still have, diesel prices at $3.40. And this speaking in U.S. terms, which again is going to provide some of that backdrop for CPI growth. So then when you look at the rent, so you see those home prices. Now let's look at price to rent. You can see that rents are just shifting much higher and are going to get pulled up, which again is going to be a problem when you look at how is inflation calculated and what are these individuals, these consumers going to have to spend on if that additional capital is going to rent. So then when you look at shipping in terms of, what those issues, they continue to move higher. This is shipping from China to LA. LA, obviously China to LA is the big one, where LA to China still remains small, but still at going back to 2011, still at all-time highs. And this just speaks again to the issues that we continue to see within the water and in the supply chain, which, looking at it a little bit differently, supplier delivery times may have peaked as of May, but when you look at where things are, so they may have peaked, but it doesn't mean that they're going to fall. And that's why we showed the tanker rates before we came into this segment, because you're starting to see some of that delivery, we're starting to get some of that backfill. You're starting to see some of that come through, starting to see demand dip a little bit, which is, again, allowing for a little bit of a recovery in inventories because demand has shaded a bit lower. Again, not a huge amount, but shaded a bit lower, allowing for some catch up. But in the meantime, when you look at CPI and PPI, they continue to trend higher. They continue to push up, which is just keeping those prices elevated. Again, looking at prices elevated versus the supplier delivery times, we're starting to see that level off, but again, not really come back down, which is we're already through July. So we're already into July, into August, and seeing something very similar. And this just looks from Robin Brooks from IIF. You get an idea of just where some of these issues remain when you look at just the supplier deliveries problems. It's not just a U.S. problem. So you look at U.S., you look at Germany, you look at Taiwan, you look at China, you look at Japan. All of these things, typically when you look at Fukushima, that was a very isolated incident for all intents and purposes in terms of what we're discussing, where right now COVID is a very global problem that has ramifications that go through the whole supply chain, which when we look here, the U.S., which is in blue, doesn't usually diverge from the rest of the world in terms of markups. But when you look at just the U.S. recovery versus the rest of the world, there's been a more of an ability to push through pricing. And that's something that the rest of the world is going to catch up on in terms of input prices, because in the U.S. and global median, so the global median is 34 countries. So you can see they're back at the highs and continuing to trend higher, because there's a certain amount of, well, I can't put this into the export market as much, so it's going to get passed through to the local consumer. And then that's something where when you look at it from a different perspective of longer delivery times and higher output prices. So manufacturing PMI delivered in the U.S. and global median across 34 countries. So the U.S. is at highs in July. So this is taking you through July, which manufacturing PMI delivery times, longer delivery times have peaked. And then when you look at what has happened so far in the other countries, it's coming up. And when you look at what's happening with COVID in Southeast Asia and China, it's going to continue to get worse, which is going to put this 34 country average back above that 2020 shock. And the same thing is going to happen on the output prices when you look at how much of that is going to get continue to get passed through, which is why we continue to say that there's a lot of stickiness behind this inflationary push, which we're going to catch up on around the world, US first, then Europe, and then Asia, to see where some of these pressure points are going to be on a CPI side as well as a PPI side. But first, we're going to go into the US and do a deeper dive on what has happened within GDP and what are some of the leading indicators telling us going forward.